Welcome back to our masterclass on the MACD. In the last video, we traveled to the origins of this indicator, met its creator, Gerald Appel, and dissected its three fundamental components, the MACD line, the signal line, and the histogram. Now that you know the anatomy, it's time to learn how to move the body. It's time to go from theory to strategy. Today, we're diving deep into the most classic and well-known use of the MACD, the crossovers. We'll learn to interpret the buy and sell signals that millions of traders have used for decades. But we won't stop there. A good strategist knows not only their weapons, but also their limitations. That's why we'll also analyze, with complete honesty, the strengths that make the MACD a legend and the weaknesses that, if ignored, can cost you dearly. This is the video where the rubber meets the road. If the first video was the theory class, this is your first day in the flight simulator. Buckle up. Before we can trade, we must understand the terrain. Every indicator has its light and its shadow. Let's start with its bright spots, the reasons the MACD has stood the test of time. Strength number one, versatility. This is perhaps its greatest virtue. As we mentioned, the MACD is a two-in-one. It combines trend identification, thanks to its position relative to the zero line, with momentum measurement, thanks to the histogram and the speed of its main line. You don't need 2 or 3 different indicators to get this information. The MACD gives you a panoramic view in a single window. It's the Swiss Army knife of technical analysis, with different tools for different situations. Strength number two, visual clarity. The creation of the histogram was a stroke of genius. Without it, we'd have to constantly be gauging the distance between two wavy lines. The histogram does that work for us and presents it in an incredibly intuitive way. With a single glance, you can see if the impulse of the current trend is strengthening or weakening. Those growing and shrinking bars are like the market's body language, and the histogram translates it for us in real time. Strength number three, divergence detection. This is the MACD's trump card, its superpower. It's a more advanced technique that we'll dedicate an entire video to mastering, but it's crucial you understand its importance now. A divergence occurs when the asset's price does one thing and the MACD does the opposite. For example, the price makes a new high, but the MACD doesn't. This discrepancy is one of the most powerful signals that a trend is losing its internal strength and might be about to reverse. It's a leading signal, an early warning that can give you a significant competitive edge. Strength number four, adaptability. Although the standard parameters we learned, 12, 26, and 9, are the industry standard, they aren't set in stone. Advanced traders can adjust these numbers to adapt the indicator to different markets or different trading styles. Trading a highly volatile market like crypto, you might need faster parameters. Investing long-term in stocks, a slower setting might filter out the noise better. This flexibility makes it relevant in almost any context. But ignoring a tool's weaknesses is a recipe for disaster. No indicator is perfect, and the MACD is no exception. Being aware of its blind spots is what separates an amateur from a professional. Weakness number one, it's a lagging indicator. This is the most common criticism, and it's fundamental to understand. The MACD is built from moving averages, and moving averages are calculated using past price data. By definition, the MACD will always react to what the price has already done. It will never give you a signal at the exact bottom or the exact top of the market. Its crossover signals, therefore, will often arrive after a significant portion of the price move has already occurred. The MACD doesn't predict, it reacts. Weakness number two. It generates false signals in sideways markets. Remember this like a mantra. The MACD is a trend-following indicator. Its purpose is to identify and ride trends. When a market has no clear direction and is moving sideways, or ranging, the MACD goes haywire. The two lines will constantly intertwine, generating a multitude of crossovers and false signals that will entice you to buy and sell repeatedly, a phenomenon known as being whipsawed. In a sideways market, the MACD is your worst enemy. It will bleed you dry with small losses. The first skill of a good MACD user is to identify a ranging market and simply ignore the indicator. Weakness number 3. It doesn't measure overbought or oversold levels. Indicators like the RSI or stochastics are bounded, meaning they move between 0 and 100. This allows them to define overbought zones, above 70 or 80, and oversold zones, below 30 or 20. The MACD has no such limits. It can go up and up indefinitely. A very high MACD value doesn't necessarily mean an asset is overbought and about to fall. It simply means that bullish momentum is extremely strong, and it can stay that way for a long time. Using the MACD to try and call tops based on how high it is a very dangerous misconception. Now that we know its light and its shadow, we're ready for strategy. And the golden rule, the unbreakable law, is this: never use the MACD alone. It must always, always be one piece of a larger system that includes, at a minimum, an analysis of price action, support, and resistance. Let's start with the most popular method, the crossovers. The most basic buy signal occurs when the MACD line, which is faster and more sensitive, crosses above the signal line, which is slower. What is this telling us? It's telling us that short-term momentum is shifting and becoming stronger than the medium-term momentum. It's a sign that buyers are starting to take control. Now, a pro tip to increase reliability. This signal is much more powerful if the crossover occurs when both lines are already above the 0 line. Why? Because it means you're entering on a small correction within an already established uptrend. You're buying a dip in the direction of the main tide, not trying to call the bottom of a downtrend. This filters out a ton of false signals. As you can imagine, the sell signal is the exact opposite. It occurs when the MACD line crosses below the signal line. This suggests that momentum is shifting in favor of the sellers. And again, to increase your probability of success, this signal is far more reliable if it occurs when the MACD is already in negative territory, below the 0 line. This indicates that the main trend is already bearish, and the crossover simply signals a continuation or acceleration of that trend. You're selling with the current. There's another type of cross, slower but often safer. This is when the MACD line itself crosses the 0 line. A cross from below to above is a more robust confirmation that the overall trend has shifted from bearish to bullish. A cross from above to below confirms a shift to a bearish trend. The downside is that it's a much later signal. By the time it happens, a good part of the move has already occurred. That's why many traders use the line crossover to enter and the 0 line cross as a confirmation to hold the position or even add to it. When is it ideal to use this crossover strategy? As we said when discussing its weaknesses, it's perfect for markets with clear, defined trends. If you look at a chart and see the price moving in a clear upward or downward channel, MACD crossovers in the direction of that trend can be high-quality entry or exit points. If the market looks like the EKG of a nervous patient moving aimlessly, stay away. Save your capital for a battle you can win. Today, we've taken a giant leap. You no longer just know the parts of the MACD, you understand its strengths, its weaknesses, and how to execute its most fundamental strategy. You know it's versatile and visually clear, but also that it's lagging and dangerous in sideways markets. And you've learned to interpret the bullish crossover, the bearish crossover, and the 0 line cross. But this is just the beginning. Crossovers are the gateway. In our next video, we're going to open the door to advanced strategies. We will dive headfirst into the MACD's superpower, divergences. You'll learn how to spot when the price and the indicator are telling you different stories, a skill that can allow you to anticipate market turns before most people even notice. It's the technique that separates the amateurs from the professionals. If you enjoyed this practical lesson and feel like you're one step closer to mastering this tool, help us continue creating this content. Give this video a big like, subscribe to the channel, and don't forget to hit that notification bell to be the first to see the video on divergences. And now a question for you in the comments. Have you ever been a victim of a false MACD signal in a sideways market? Share your experience. We all learn together. We are Money Talks US. It's been a pleasure guiding you through this step. I'll see you in the next video to unveil the secrets of the pros.